So, I've broken my own rule and I've bought into more Chinese stocks today. So for those of you who don't know, or if it's your first time here, I was one of those dudes on YouTube saying that I was all in into a particular stock. And 2 years ago, I was actually indeed all in into Alibaba. And I've averaged down from a high price of 220 all the way down till today at having a cost price of near $110 per share. And the story I told myself was that I couldn't find any other opportunities in the market that offers a much greater or better risk reward. So I'll talk more about how I look at this entire risk reward paradigm later in this video. So for those of you who actually click into this video, I'm just going to reveal it here. I've actually averaged up into my Tencent position in the Hong Kong market right in the morning. So I actually bought 100 shares, which is one lot in the Hong Kong market at around 368 Hong Kong dollars per share. I have a grand total of 500 shares of Tencent at around a $295 cost price. So I still remembered the first share of Tencent that I acquired was right around the $330 to $340 price point, and then I averaged down significantly, especially during that time period where China was undergoing that particular election, whether is it political or even economics analysts saying that this is the end of China, and many investors were basically throwing in the towel. That was when I managed to essentially kind of catch the bottom at Tencent when it was trading around $216 per share. So I think even before I released this video, I can already feel the heat in the comment section. I'm saying that, oh, Chi King, why didn't you buy much earlier? What essentially changed between this X amount of time period? Why didn't you buy in at the lows? Why are you trying to chase the highs now? Are you experiencing some sort of a FOMO, which is fear of missing out? So of course, let me just try to explain my thought process. And since all these videos are going to be archived onto a YouTube platform, I can essentially look back at this decision. But anyhow, I think I come from three different angles. I think the first angle is really on practical reasons. First things first, I honestly, one lot of Tencent share in the Hong Kong market is equivalent to around 5,000 to 6,000 Singapore dollars. So you ask me, why didn't I accumulate more at 200 over dollars? Why didn't you average in or buy even more and average down your entire cost price? Practical reasons, we all have some sort of cash flow that we expect in our lifetime. And back then, that was the X amount of dollars that I have. I cannot just average in and just go into margin. At least personally for me, I advocate against using margin. So it just so happens that I haven't really been accumulating aggressively over the start of this year. So I just happen to have more dry powder. And when I see this opportunity, that's why I pounced on it. Secondly, I think it's purely from an allocation perspective. So I think for those of you who do follow me, I think until today, I still hold the position that Alibaba as a company and as a stock price, given its fundamentals, given its valuation, and how we are currently at a turning point of the company itself, I still believe that it's one of the most, if not the most, favorable risk-reward kind of company. I really do see very little downside and quite a huge upside. I'll explain more later on. Even after adding Tencent at around $270 per share, my allocation is still less than 15% on cost. So I think it's important to kind of differentiate your portfolio on cost basis and on a valuation basis, which is the current price. So on cost basis, it's less than 15%. And I think it's not my first time that I talked about it, that I do believe that if you buy both Alibaba and Tencent, you essentially have exposure to the entire Chinese economy. But at least based on current circumstances, these two companies own the few most important applications in China today. That said, when I compare on an allocation basis on my portfolio, Tencent right now sits around 13 to 14% of my portfolio on cost, while Baba sits at 48% on cost. And of course, this predicament, I only have myself to blame because I really started out my portfolio by having 100% into Alibaba, and then I slowly started adding in other positions. That's why the Alibaba allocation slowly comes down, but it's not coming down fast enough. So yeah, I think that's generally the perspective. So I think earlier this year, in one of my separate videos, I did say that I wanted to bring my portfolio closer to parity, meaning I want 50% China and 50% US. But I'll explain further on why I'm a little bit reluctant in allocating, or why I have a pretty hard time or challenging time in trying to pull the trigger on some of these US names. But yeah, back to the topic, I think on an allocation level, I still have a big proportion in China stocks, and within that China universe, Alibaba still holds a very big percentage, or at least it's near 50% of the entire portfolio. So why I added to Tencent? Simply put, I just wanted a bigger pie or at least on a portfolio level, I wanted more exposure to Tencent as a business. And last but not least, I think on a very rudimentary level, if I look at the technicals of Tencent today, it is kind of range bound. You do see the 50 moving average crossing the 150, so I think you need kind of a longer time period to confirm the bullish signal. But that said, I think the share price is already above the 200 moving average, but there's still a kind of a resistance at a $400 level. Whether is it range bound, you can say that it's range bound, you can say that it's a psychological level. Whatever it is, that said, technicals is not my main motivation or main driving philosophy in how I invest. I honestly just think that Tencent has a superior business model compared to many of these other companies, in fact, and I just don't have enough allocation. That's why I'm adding here. Oh, and I think I missed this point. I think in one of my previous videos, when I essentially revalued my entire portfolio and looking into Tencent specifically, I have their intrinsic value calculation to be right around $500 to $600 on the conservative side. So if I really am thinking from a business owner perspective and I want to hold Tencent for the longer term, I think reaching $600, $800 or even $1,000 per share is foreseeable, at least in the coming decade or so. So really, by entering at $370, $360 or even $300 per share, does it really matter? I think in the grander scheme of things, not really. And besides, because I'm averaging up into the position, even after adding this tranche, my cost price is right around $295, and it's something that I'm comfortable with. That's why I proceeded to add into it. I think one sub pointer that I wish to add as well is really this idea of anchoring. I think a lot of investors are very ready to kind of average down because you might be thinking at the back of your mind, oh, I'm actually getting this at a much better deal. However, I think a lot of people actually get into the trap about this idea of anchoring effect, saying that, oh, I bought at Tencent at 210 Hong Kong dollars, for example. Why would I bother paying at 280, 300, or even today, $370 per share? I think we can kind of erase this idea of anchoring. Let's assume that you have no position today. Judging from a business quality, business fundamentals, and its valuation today, do you think it makes sense? And regardless of your previous experience with the stock itself, if it makes sense, I think you should continue adding to the position. Because let's not forget, we are here to try to build a long-lasting and a compounding portfolio. We are not really trying to trade in and out, just maybe buying at a low and then quickly selling it at a 10-20% gain. Similarly, I think from my own personal experience, when you look at my relationship with Meta stock, I think Meta from my initial cost price at almost 3x, I didn't take any profits, and right now it came back down to nearly just only a 2x, which is a 100% gain. And from that experience, I didn't shy away and say that, I could have earned X amount of dollars more. Instead, I decided to add to the position. It's still a company that I desire and wish to continue participating as a shareholder. And that's how I essentially look at and interact with many of these positions in my portfolio. So I think circling back to the point where I said that Alibaba, in my own humble opinion, I still think Baba has the best risk reward, essentially due to how I look at risk. So I think a lot of people have different definitions of risk. So in the traditional finance space, people tend to look at risk in terms of the volatility, and in the mathematics term, they use standard deviation. Some people like to look at probability on what's the probability of you reaching a particular price point, and you can kind of use options to kind of construct the trade. But to me, how I look at risk is relatively simple. It's just the probability of a permanent loss of capital, meaning how sure or how unsure I am when I put $1 into this particular investment today, whether if I hold it long enough, whether it's a 5-year, 10-year time horizon, do I think I'll lose this dollar away? So that's basically it. And when I look at Alibaba, in terms of its setup, in terms of its business fundamentals, in terms of its valuations today, they're essentially range bounded between the $60 to $120 range. Honestly, in my own humble opinion, even though it's trading closer to $70 to $80 today, even if you have a cost price of $120, if you hold it long enough, by long enough, at least to me, a suitable time horizon is probably closer to 7 to 10 years. If you indeed hold long enough and you buy it in at $120 at a cost price, I honestly don't think that you'll lose money. You might not make a multi-bagger, meaning some people might bring in the idea of opportunity cost, what is the risk of opportunity, etc, etc. But to me, I just really dislike the idea of losing money. And even if you enter into Alibaba today, if you hold it long enough, I honestly don't think that you'll lose money. So that's basically just my perspective on how I look at this risk-reward paradigm. And that's why I have been averaging down all the way from 220 to 110. I have been averaging down because I don't mind having an outsized allocation. And truth be told, when I look at my China position today, my entire China position, my core few Chinese position include Alibaba, Tencent, Haidilao, Chinese banks. Aside from Chinese banks, which is largely speculative, the other three companies, given the margin of safety, given how I look at the business today, I don't think that there will be a very big risk in terms of losing a permanent loss of capital. That's why I think just amongst these three positions alone, I have close to 6 digits or around 100 grand. So that's just my own philosophy and how I allocate capital. So of course the intuitive question would be, if you think Alibaba is so good, the risk reward is the best, why are you not allocating more? If I touch my heart and I ask myself, if I didn't start off with a 100% allocation to Baba and then start to diversify away, but instead approach it from a diversified approach, meaning maybe I have 10 stocks each with 10%, of course I'll be adding to my position because yeah, I think Baba right now on a cost basis, it's still 48% of the portfolio. It's kind of too much for me. And if I continue adding, I can kiss goodbye to the dream of trying to achieve parity or even kind of achieve that level of diversification that I wish to achieve or set out to achieve. So I think just to pivot away and to give you a brief recap of my journey, for those of you who have been here since day one, you guys are the OG, I'll give you 2 thumbs up. For those of you who are not, don't forget to smash the cute little like button. But anyhow, I really started off by just going all in into Alibaba, just having a very naive thought. Truth be told, it's because when I started out, my portfolio wasn't big. I think in terms of income to portfolio ratio, it was not huge. I think it's less than 1. And my expected income and incoming cash flow is very easily able to move the needle of the portfolio. However, as you slowly grow the portfolio over the years, you can tell that it's getting harder and harder to move the needle. And that's why you start to adopt a much more prudent approach in trying to manage your money and to allocate it effectively. So I think back then, before I even start with Baba, I really started off with Singapore stocks. And because Singapore is my base country, there's this home country bias. And after that, I think after that entire 2020 pandemic, I started to switch over to US tech stocks. And I was having some fun trying to trade some of these tech names. And of course, hindsight is 2020. If I just held on to Microsoft, Apple, I think many of these companies have already brought me to the moon. And from then on, I stopped my nonsense and I really just started studying or deep diving into all this idea of value investing, finding your own investing philosophy, etc. And that's why I stumbled into the Hong Kong market. And as you guys remember, end 2020, that was when Hong Kong market started to enter into a bear market. And that's why I essentially just switched entirely 180. I went entirely into the Chinese tech market and I have never looked back since. And from then on, I just continued accumulating to my Chinese tech positions and I slowly added in from Alibaba only, or only Alibaba, to adding in KWeb, to adding in Tencent and some of these other Chinese names. But I think more importantly, back then, if you still remember in 2022, there was a slight correction in the US market. And that was when I saw this shift in sentiments and I was thinking, hey, actually some of these other US tech names started to look interesting. And that was when I started adding into the US positions. And I found US names that also give better proposition. And truth be told, when I compare 2021 versus today in 2023, I think I'm faced with rather similar issues. I find it a little bit hard to basically convince myself to add to some of these US names that I personally do follow and have an affinity and have a relatively okay understanding in. And I don't want to add for the sake of adding, just because I want to achieve diversification. And I think my principle until today is still fairly firm. I just want to add to value. And of course, some may say that value is in the eyes of the beholder. So at least for this year, in the first 4 months, Hong Kong is pulling ahead after being beaten down for the last 3 to 4 years. And within the Hang Seng tech component, Baba seems to still be the laggard compared to many of their counterparts. I'm not saying that we will definitely revert to the mean, or I'm not saying that this is the bottom and we can all go in and buy Alibaba, but I think we do have a pretty strong proposition, like I said, when you look at it from a risk-reward perspective. And last but not least, Tencent is going to report their earnings on the 14th of May. And remember to stay subscribed to this channel because I'm definitely covering Tencent's report. So I think as always, I've tried my best to be as transparent as possible. I don't like this Chinese term called horseback cannon. I don't want to tell you that I bought into a stock after the stock has rallied for 20, 30, 40%. So right now, I'm being as transparent as possible. For those of you who appreciate it, whenever I make a move, I'll share my own thinking process, I'll share my philosophy, I'll share my cost basis, etc, etc. And yeah, for those of you who appreciate it, please remember to help smash the like button. That's all I ask you guys to do. If not, I'll see you guys in the next video. But more importantly, and hopefully in 2024, I'll see you guys on the moon. Goodbye.